Yesterday, Fermi Inc. did something most stocks never do. It moved 23% in a single session on volume, roughly 4 times its 90-day average. This morning, thousands of investors are either congratulating themselves, kicking themselves, or about to make a very expensive mistake. Here is the uncomfortable reality about big single-day movers. The people who made money yesterday and the people who are about to lose money today are often reacting to the exact same headline. So which side of that trade are you on? And more importantly, how do you know? Let's start with the facts, because the explanation floating around social media this morning is only half the story. Fermi Inc. reported preliminary second quarter revenue guidance that came in approximately 31% above the analyst consensus estimate. That is a significant beat, not a rounding error, not a revised accounting treatment. They also disclosed a strategic partnership with a large-scale infrastructure operator that expands their total addressable market into a segment they previously had zero exposure to. On paper, that is a legitimate catalyst. Two independent pieces of positive news arriving simultaneously is the kind of combination that justifies an outsized single-session reaction. Here is where it gets more complicated. When you look at the options market activity in FRMI, in the 48 hours before that announcement, call volume was running at roughly 340% of its trailing average. Either someone got very lucky, or information was moving through the market ahead of the official release. That is not an accusation. Unusual options activity ahead of a corporate announcement is documented across hundreds of historical cases. What it tells you as an observer is that a portion of yesterday's 23% gain was not a reaction to new information. It was a catch-up by the broader market to pricing that sophisticated participants had already embedded. The actionable insight here: when you evaluate a catalyst, don't just ask whether the news is good. Ask whether the price already knew. A stock that surges 23% on news that was partially priced in by options flow has a very different risk profile than one that moved on a true surprise. Always check the options activity in the 48 to 72-hour window before any major move. This is the question everyone is actually asking this morning, and the honest answer requires separating two distinct issues: whether the business deserves a higher valuation and whether this particular price right now is the right entry point. Before yesterday's move, FRMI was trading at a forward price-to-earnings multiple that was already at a modest premium to its sector median, roughly 24 times forward earnings versus a peer group median, around 19. After a 23% gain, that multiple is now sitting closer to 29 times. That is not automatically disqualifying. Growth companies frequently command premium multiples, but it does mean the bar for execution just got meaningfully higher. The stock now needs the revenue beat to be real, sustained, and accompanied by margin expansion. One strong quarter doesn't guarantee any of those things. Here's what history tells us about this setup. Academic research on large, single-day equity moves, specifically looking at stocks that gap up 20% or more on earnings-related catalysts, shows a consistent pattern. In the subsequent 30 trading days, roughly 58% of those stocks give back between 1/3 and 1/2 of the initial gain. The ones that don't tend to share a specific characteristic, they continue showing institutional accumulation in the days immediately following the spike, rather than distribution. Watch the daily volume on FRMI over the next 5 sessions. If volume remains elevated and price consolidates in a tight range, that is accumulation behavior. If volume spikes on down days and thins out on up days, that is distribution. Institutions using the retail excitement to exit positions they built at lower prices. None of this is financial advice. It is pattern recognition applied to publicly available market data. What you do with it is entirely your decision. Let's build something durable out of this FRMI situation. A process you can apply the next time a stock jumps 15, 20, or 30% overnight, and everyone around you is either panicking or euphoric. Step 1. Identify the catalyst type. There are three categories. A structural catalyst changes the business permanently. A new market, an acquisition, a regulatory approval. A cyclical catalyst reflects good conditions that will eventually normalize. A commodity price tailwind, a temporary demand surge. A sentiment catalyst is essentially narrative momentum with no fundamental change underneath it. FRMI's move appears to be a mix of structural and cyclical. That matters because structural catalysts tend to hold price gains better over time, while sentiment catalysts are the ones that fully retrace. Step 2. Quantify the implied expectation. If the stock is up 23% and the catalyst was a 31% revenue beat versus consensus, the market is telling you it believes this isn't a one-time anomaly. You need to decide if you agree with that assessment, not based on how the news feels, but based on what you can verify about the company's forward pipeline, competitive positioning, and gross margin trajectory. Step 3. Define your asymmetry before you act. This is where most retail investors fail. They buy a big mover because it feels like momentum confirmation, without ever answering the question, what is my downside if I am wrong, and does the potential upside justify it at this price? A stock that already moved 23% and trades at 29 times forward earnings has compressed your upside and expanded your downside relative to where it sat 48 hours ago. Step 4. Set a time horizon that matches your thesis. If you believe the partnership announcement is transformational over 18 to 24 months, short-term volatility is irrelevant. If you're trying to capture a second leg of momentum in the next week, you're playing a completely different game, one with a much lower base rate of success. Know which game you're in before you place the trade. We opened this video with a simple question. Which side of the trade are you on? Now, you have the tools to answer that for FRMI and for every big mover that comes after it. The real question this raises is broader. How do you build a systematic process for evaluating momentum stocks without letting emotion make the decision for you?